Hello everyone, Luke Gromen, FFTT. Hope everyone has had a great weekend. I know we have certainly had a great weekend here. Some baseball, some track. Got a good leg day in this afternoon, so we're ready for the week. So I'm going to jump right in here to the questions. Thanks everyone again for joining. First question is from Jason. What is the timeline by which we will know that the expected transitory inflation spike is indeed temporary or perhaps becoming secular? What might be a signal or two? I think it's a great question. For me, it really comes down to watching a couple things. Number one, watching the government spending plans as it relates to stimulus, and watching Fed QE in terms of its pace and are they buying enough treasuries or not. If the government stops stimulus, I think that's going to make the inflation spike transitory. If the government keeps re-upping stimulus, as I expect that they will, because I think they have to based on the fiscal position they're in post-COVID, and the Fed buys enough of those treasuries, then I think it's not going to be transitory. I think we're going to be in a much more secular inflationary environment than people currently expect. If the Fed does not buy enough of the treasury issuance, regardless of whether the U.S. government does more stimulus or doesn't do more stimulus, that I think will prove to be transitory for the inflation spike, because you're going to get either the Fed not buying enough of more stimulus, which means you're going to see the U.S. government crowd out global debt markets. You'll see rates up, you'll see the dollar up, and you'll see, I think, commodities down eventually. Or if you don't get more stimulus, as we talked about before, I think that makes it transitory. The second question is can you, from SS, can you comment on the Turkish move to restrict Bitcoin and the issues with crypto exchanges there, just as possible playbook for the U.S. and Europe? I think what's happening in Turkey, I think, is potentially instructive on some level. Obviously, this isn't the first crypto exchange problem there's been over the last 10 years in terms of some issues, and you can kind of look at a number of those. Mt. Gox famously, maybe most famously. So I don't know that that's new. Unfortunate for those involved with that, certainly. But the thing I would say as it relates for model, in particular to the U.S., to a lesser extent for Europe, Turkey does not issue the global reserve currency, obviously, like the U.S. does. The global reserve currency issuer has to provide for free flow of capital in and out of its borders. That's the deal. The U.S. does issue the global reserve currency, obviously. And so my thought here is there's a lot of talk about banning Bitcoin these days. If the U.S. moves to restrict or ban Bitcoin in any real way, they're going to be effectively putting in a capital control to a $1 trillion asset market, $1 trillion plus. That is going to be an alert to 45 trillion other dollars of foreigners sitting in the U.S. right now. It will be the first warning that the U.S. will, if it needs to, put in capital controls on you. They will gate you in and put walls up on your capital. And so my take on should the U.S. ban Bitcoin or put capital controls on Bitcoin, I think it would be a galactically bad idea. I think it would be penny wise if you're interested in the whole dollar hegemony thing, which I think is actually a disadvantage to us now, as we've talked about a number of times. But if you think if you want to run that playbook, it would be a penny wise, pound foolish move. Because again, you would be alerting $45 trillion in foreign capital sitting in the U.S. You'd put it on notice that it would be at risk of being gated. I don't think that's a good idea. We'll see what they do. From John F. In your last Periscope, you mentioned Bitcoin's outperforming gold due to no unbacked futures for Bitcoin, but Bitcoin has futures on the CME. Why does this not suppress the Bitcoin price? Is it due to the Bitcoin futures not being as developed versus gold futures? I think that's a small part of it is they're not as well developed. It's a smaller market still. With that said, I think, and we wrote about this quite a bit when the futures first rolled out, that cash settled futures does shift price discovery away from the underlying towards cash. We wrote about it quite a bit, and we tweeted about it. You can find some of our old tweets on that. It is interesting that when one of the two Bitcoin futures markets shut down in, I think, April of 2019, it was right around that bottom in Bitcoin. It might be coincidental. I'm not sure. With that said, I think the bigger issue and the thing I would focus more on is there is no London unallocated Bitcoin market anywhere in the world. And that's really the big thing for gold, which is if I wanted to buy $100 million worth of gold, credit gold, I could get done now. Boom. Assuming I had the $100 million, which would be a nice problem to have. I want $100 million in gold. Boom. Unallocated, you're done. $100 million. Now, if I wanted $100 million in physical today, it'd probably take me a couple months based on what I'm hearing. And so it's this unallocated credit gold market that does not exist for Bitcoin, number one. And number two, Bitcoin is decentralized, which I think is a very valid point that a lot of Bitcoiners make, which is in unallocated gold, because of the physics, when gold gets sold down, because of the gold stores are centralized, it takes some effort to, if you want to basically call BS on the sell-off in gold, you've got to go to your broker, you've got to get your gold. And the reality is a bunch of small players can buy a little bit of gold, and that could certainly drive it. But the big players who could do it all in one swoop, they're not going to do it for any number of reasons, or they can't do it by regulation for any number of reasons, which is to say they don't like the price of gold. A reasonable sized hedge fund could go to COMEX and clean out a lot of the gold tomorrow if it wanted to. It's not going to happen. It hasn't happened. The fact that it hasn't happened should suggest that there's a political reason there for why it hasn't happened. The point here is that Bitcoin's not like that, where if Bitcoin sells off sharply, you have 100 million people with smartphones that can get on and start buying up actual physical Bitcoin. And that's a very different dynamic than what we see with the structure of the gold market. So I think those two differences have helped describe a big portion of why gold has really not done very much while Bitcoin has. Let's see, from CB, you elaborate a lot around the need of real rates to go deeply negative for the U.S. to remain solvent. Do you expect real rates going deeply negative, below negative 2% on 10-year this quarter or this year? The short answer is yes, I still expect real rates to go deeply negative. $64,000 questions are when, and when will it actually be reported as such? I think it's very possible we are below that on a real rate basis now when you really look at what's happening with commodities, what's happening with services, what's happening with tuition costs, healthcare costs, what's happening with semiconductor shortages, supply chains. I think if you did an honest appraisal of what CPI is right now, we're probably at -4 or -5%, maybe -3% on real rates right now. However, when will it be reported? Will it be reported? I suppose there's a chance it'll never be reported as such. But I ultimately think it will. Maybe later this year we'll break to new lows. I think once we are forced into yield curve control, the U.S. is forced into explicit yield curve control, is probably the catalyst to when we'll see those negative real rates be reported toward the levels that I expect them to eventually reach. And so some of that is a multifaceted. When do we get YCC? I'll touch on that in a bit. From OC, what jumped out at you in the book Twilight in the Desert, something I tweeted about earlier this week? Takeaways you found interesting. First, the Pareto principle as it related to oil fields I thought was interesting. And by that I mean there is a very extreme form of the 80-20 rule that works in oil production. So that was one, is a surprisingly large percentage of the world's oil comes from a tiny fraction of the world's oil fields. Number two, I thought was interesting when I read the book, the age of those oil fields. They are very, very old. And these oil fields all follow some version of a bell curve in terms of their production profile historically. Number three, translating that concept to my thought that if I was the owner of one or more of those big oil fields, I would not want to own a lot of bonds, and particularly not a lot of low-yielding bonds, if/when just a few of those very, very old, very, very big oil fields went 100% water cut or went fully depleted, basically stopped producing. Because the moment that happened to just a few of those fields, the ensuing inflation would likely haircut those bonds on a real basis pretty quickly. So those were the thoughts that really grabbed me most out of that Matt Simmons 2002 Twilight in the Desert book. From Kevin, when does yield curve control or YCC become openly acknowledged, and what are its short-term effects? Also, is pandemic unemployment insurance the precursor to UBI, and how does that look for employment in the short term? To me, YCC, I think, is a function of a number of different dynamics at play, number of different levers. What's stimulus doing? What's the underlying pace of the recovery? What's going on with COVID? What's going on with the bond market? What's the short-term effects are ultimately all going to be a function of those factors. How does that play out? The short-term effects of YCC, I think it'd be inflationary. I think it'd be very good for risk assets. I think it'd be very good for GDP. I think it'd be bad for the dollar. I think broadly speaking, it would amount to basically the beginning of a debt jubilee, if you will, on a real basis, by basically capping yields and the price of a lot of other things going up against those capped yields, which allows economies to earn their way out of their debt positions, whether you're looking at sovereigns all the way down to households. If household wages are growing 10 or 15%, and their mortgage is pinned at 2 or 3% by the Fed, you leave that for 5 years, they're going to have a lot more room in their budget at the end of those couple 3, 4, 5 years to buy other stuff. And then let me see, regarding the pandemic unemployment insurance, in my opinion, yeah, I think it is a precursor to UBI, and I think on some level it is normalizing UBI in a way for certain policymakers that's probably pretty helpful. I do think, in my opinion, UBI will probably be a political necessity at some point in the next 5 years, just given what's happening with technology and automation, artificial intelligence, what's that doing to what that is doing to job markets. And so I do think there is an element of that. That is not to say that COVID is some cover for normalizing UBI, et cetera, or any of these World Economic Forum long-term goals, et cetera. I just think it's one of these useful dynamics if you're a policy. If I was sitting in their seat, I'd be looking at some of these studies like McKinsey has done and what automation and technology are going to do to jobs markets over the next decade. Looking at that and going, wow, this could really be a political problem at a time where we're already seeing social disruption across the U.S. and Western democracies more broadly. And boy, it gives me the cover to start trying out different concepts for UBI to hopefully make a transition to an economy that looks more like a nation of shopkeepers down the road, where people maybe are collecting a bit of a check from the government and then also able to pursue a passion, art, small shop, through the internet, etc. Things that you would have a much more robust, flexible economy. Hopefully, that's the happy outcome. So that's it for tonight. I had a couple questions about what I meant about that tweet today about why actually gold at 50,000 or Bitcoin at $1 million is not a threat to the dollar. It's actually the only way the U.S. can win the great power competition with China, full stop. It's a lengthy discussion. I'm going to touch on that this week in Tree Rings. So it's one of those things I will spend a little bit more time on there. In the meantime, as always, if you're interested in getting more of these types of updates, check out FFTT-LLC.com, find out what we're up to. You can also link through to sign up for Tree Rings there if you're interested at FFTT-LLC/treerings.com. And otherwise, everyone have a great week. Hope it starts off great. Hope it finishes great. Everyone stay safe and healthy. We'll talk with you all soon. Take care, everybody.